Welcome back to Mostly Growth, the #1 podcast in product monetization. And today we're going to talk about why usage-based pricing is taking off and how it's breaking the traditional SaaS playbook. Now, CJ, I heard you just got back from Disney. Is that what inspired your interest in usage-based pricing? Do they charge you per ride?
They charge me for a lot of things, Kyle.
So Disney doesn't totally have usage-based pricing, although it sounds like they've got some interesting pricing models around, like, if you want to go on more rides, you got to upgrade. I've been noticing like interest in usage-based models within tech have been taking off. And it's specifically been like the last 6 months or so. And I think one of the drivers is that investors used to hate usage-based pricing. And now founders that I talked to were like, my investors really want to see some form of usage-based pricing. Can you help me with this? Or like, does this make sense for my business? What gives?
It's funny because I interviewed Lee Kirkpatrick, who took Twilio public. I believe it was in 2015, maybe 2016 range. But he said that they were basically the first pure play usage-based company to go public, and they had to educate the market on their business model. And he had to teach them this is actually better than what would be just a pure play SaaS company. And I have really great predictability and I get some extra on top. And I think they kind of led the way for a lot of other companies, especially B2C facing companies. I don't know many companies these days coming out with a pure seat-based model. The majority of them, I think, are leaning into usage, and the investors seem to love it.
One of the things is that, like, for investors, they only seem to want to back AI native companies or companies with an AI story. But then if your pricing is per seat, they all think that your business faces an existential threat as seats either plateau or decrease, or you're just sort of calling yourself an AI company, but you're not really delivering like work product autonomously for your customers. And so there's almost something of like the pricing model pattern matches you is either an AI company or a SaaS company.
Do you think there's credence to that?
For companies that are AI native, they have a ton of token cost. It just like underlying costs of their business. It is very challenging for them to offer any sort of fixed rate subscription plans. So I think that like there is something there where, hey, if you can just like give AI for free to all of your customers, we talked about before this trend of like bundling AI into your plans and just raising the price by 20%. If you can do that and it's profitable, you're probably not seeing that much usage of AI across your business if you have the cost structure to afford that. And so I think there is some element of pattern matching. Where I think it breaks down is this trend we talked about earlier around going from software as a service to service as a software. If you're essentially owning the tech plus the services and you kind of sell those as a bundled solution. So say you're taking over a customer's outsourced customer support, or maybe you're a marketing agency essentially, but delivered as an AI product. If you're doing that, like, I don't necessarily know that you'd want to charge based on AI credits, for example. Your customer probably wants to buy the service, like they want to buy the deliverable from you, and there's a cost to that deliverable. And I don't think that they're used to paying for services on a usage-based model, or at least for most services.
You alluded to it's better for the company because of their underlying cost structure. What you didn't say is it's better for the customer based on how they want to transact and because of the outcomes they're getting.
Well, yeah, I don't think very much of this is being driven by customers. Like some people say that it is, but I don't think that many customers are asking for it.
I'm not asking for it. Are you asking for it?
When customers do ask for it, it's more that, hey, look, I'm dipping my toe into this. I don't know if this is going to work. This is like an experimental AI budget. Could we do something to like get started at a lower rate? And maybe that like getting started is on a usage-based plan. And so I think like there's some of that, but once they're serious about the product and adopting it in production, and they see what their bill is going to look like at renewal, like, oh, actually, I didn't really love this usage-based thing.
Well, just to bring it full circle, I feel like investors are excited about this because they think it can lead to outsized returns when it comes to whatever revenue you're forecasting. If you grow with workloads and you get fully into all the workflows of a company.
A good company would maybe have what, 100, 110, 120% net dollar retention, but token consumption is growing at a rate where if you could attach to that type of metric, you'd maybe have like 1,000% net retention, not like 100%.
So I think the investors like it because of that net dollar retention. Like, oh, can this be 150, 180% NDR company once they're fully embedded. And also it helps guard against AI actually deleting the jobs that, this was supposed to be built for, right? So that's the downside protection. But I think the companies like it because it allows them to forecast their costs better and know that their gross margin isn't going to completely evaporate overnight. So it's kind of like all the same, but I just think the incentives and the viewpoints are slightly different. And then the customers, they don't really love it, but they are paying for it.
Hey, thanks for listening. We'll be right back after a word from our sponsors. Here's a question. When was the last time you really had time to focus on growth and not chasing contract renewals, tracking shadow IT spend, or explaining rising software costs to the board? Yikes! The truth is, traditional spend management is broken. If you're still piecing together data from 5 different systems just to figure out what you're actually spending, while vendors keep on pushing those auto renewals and price hikes, my friend, I got a solution for you. That's where Tropic comes in. Tropic is an intelligent spend management solution that consolidates your spend data and processes into one unified offering, enabling insights and decisive action. It doesn't just show you where the problems are, it helps you solve them. From spotting hidden optimization opportunities like duplicative spend, to automating those painful procurement workflows, to giving you the best market data that turns every vendor negotiation in your favor. Tropic combines smart insights with real human expertise to keep you ahead of the curve. And I can say firsthand because I've used them for over 2 years. Their SaaS platform helps me with price checks. It helps me keep my calendar organized of when renewals are coming up and I can actually visualize it. And let me say, it saves me more than 10 hours a week on vendor management, and we've saved a ton on renewals. I'm walking into the boardroom with a lot more confidence. Isn't it time to turn your spend management into your competitive advantage? Visit tropicapp.io/mostlymetrics. That's tropicapp.io/mostlymetrics.
If you run go-to-market, you already know the problem. Your go-to-market data is everywhere. Ads, CRMs, sales calls, marketing, spreadsheets, but you're still guessing what to do next. HockeyStack is the AI platform for modern go-to-market teams that collects all your customer data and unifies it into a single system of action. Then you deploy AI agents that prospect the right accounts, help reps close and upsell deals, improve forecast accuracy, and automate what's already working across sales and marketing. Instead of running 5-year-old processes manually, your go-to-market team finally has agents that understand your ICP, your funnel, and your buying motion, and they execute on it. That's why teams like RingCentral, Outreach, ActiveCampaign, and even Fortune 100 companies rely on HockeyStack to cut through the noise, eliminate wasted spend, and make better go-to-market decisions faster. That's HockeyStack, the AI platform that helps go-to-market teams make space to think and win. Here's a growth tax nobody talks about. Every new monetization model you ship creates a nightmare for your finance team. Add usage-based pricing? Now you're tracking consumption against commitments. Launch product bundles? That's multiple performance obligations per contract. Offer mid-cycle upgrades? Woo! Good luck reallocating revenue manually. But that's exactly where RightRev shines. RightRev is the revenue recognition engine built for companies that can't afford to let accounting slow down growth. When your RevRec is automated, your product team can ship new pricing without asking finance for permission. And your sales team can close creative deals without worrying about downstream chaos. To get up on my CFO soapbox for a sec, I love talking about creative pricing models, hybrid pricing, credits, tiered usage. But I've seen too many companies where the sales team is celebrating a huge quarter while finance is still trying to figure out how to recognize half of it. In a world where your pricing model might change 3 times next year, that flexibility is everything. If you want to scale your monetization without breaking your books, visit RightRev.com. That's RightRev.com, where modern monetization meets bulletproof accounting.
What's interesting here to me is that there's a big desire on the company side to move towards a usage model for all of these reasons, but they're kind of jamming it down the customer's throat, at least in some cases. And I think the switch that needs to kind of go on for people is that they need to build a usage-based business very differently than they might have built a traditional SaaS company if they want this to really work.
And I think usage-based is not a pricing mechanism. It's how you run a company. And you got to really think about it that way.
When we went from on-prem to SaaS, like we had to earn the renewal, like customer success became a thing. We moved from like buying all upfront to annual contracts. When you think about moving to like much more of a usage-based model, it goes even further. Like there's no shelfware. We have to be earning the customer's usage every single day if we want to recognize the revenue, if we want to expand the customer. And so like every team actually needs to orient around driving adoption.
Are there some things that companies need to be aware of what might break if they come into this with a traditional SaaS mindset?
I thought we could go back and forth on these of like what is most likely to break. The first thing for me is sales commissions. It's so for for usage-based businesses, there's a that you could customer could maybe buy on an on-demand or pay-as-you-go basis or a subscription basis. Like most companies tend to sell usage-based subscriptions more than pay-as-you-go. But when sales is getting comp just on like the bookings for the customer, their incentive is to like get that booking number as high as possible. And so if the customer is maybe booked 100K, they only consume 50K. It's great for the sales rep's commission, not so good for the business because you now have an unhappy customer who might churn or downgrade. You also probably slow down the deal by trying to get too much up front. And so sales commissions can't just be tied to, first year bookings.
You also have an unhappy CFO because you can only recognize the revenue associated with this contract when the performance obligation is met, which means you use what you signed up for.
Is that true for all of these plans? Because I think for some of them, if it's like, hey, it's an annual subscription with up to X amount of usage, can you just recognize it like on a monthly basis, but then you accelerate the RevRec if there's overconsumption? Like I've seen different companies approach that differently.
To give you the canonical example, Snowflake, they only recognize revenue when you use what you signed up for. They have this bucket that is your remaining performance obligation, RPO, and that's the entire contract. So if you sign up for a 3-year contract, that's $300,000. That goes in that bucket, and that's your backlog essentially that you chew through over time. And you can collect the cash up front, which is great for business. Most Snowflake contracts are annual prepaid. So let's say it was a 3-year deal, it was 100, 100, 100. It would actually probably be ramping, but to keep it easy, you get that money up front to run the business, but you can't recognize that revenue until it actually gets used.
Is that true for every usage-based company? Because I've seen some that, I'm not a revenue recognition expert, but I've seen some that have structured their deals so that they still recognize at least some revenue based on time. But usage is an accelerant, right? If usage goes over what someone is signed up for. But I guess what are the nuances there?
I'm not an ASC 606 expert, and I don't pretend to be on TV either. So we probably need like our friends from RightRev to step in here and tell us about it. But it also depends on how much of it you break into a platform fee, which can be recognized right then and there. A lot of these companies will have a platform component and then the usage or token component that you draw down over time. And then if you think of like a gift card, there's some semblance of this concept of breakage. If you don't use it, when do you get to recognize it over a certain number of days? So I don't know the specifics on that portion, but there are different ways to skin the cat to make sure that you eventually bring it home. But at least in the short to medium term, if you oversell a contract and it doesn't get used, it's going to sit in this nebulous accounting backlog land where you can't immediately recognize it. And I mean, the bigger point overall is that customer is not going to renew at a higher rate, and they may not even use what you had there ever.
We talked about sales commissions, revenue recognition could break depending on the model. And then, yeah, to your last point, renewal conversations. I mean, to me, there's some customers that might hoard their usage and like be so protective of not wanting to overuse that they keep it to like one team or one individual, or they save it for like a really mission critical project. And like it just limits overall adoption, limits stickiness. And it probably means the customer has underconsumed going up for renewal. On the flip side, there's some companies that just burn through their usage really, really quickly. And then they're looking at a massive increase in spend for the next year that feels like they're blindsided by it. And so it just either way, renewal conversations go from, oh yeah, we have the same number of seats, we'll renew at the same rate, or like, oh, we got 10 more seats, totally fine. Goes from a really easy conversation to a really challenging conversation.
So if you think of what the traditional SaaS model is, it's booking leads to revenue. In a true usage-based world, it's actually usage leads to revenue, which leads to a bigger booking, maybe if you're successful. And that renewal conversation, it's not always just this one date on the calendar like a lot of SaaS stuff is. Like, this is the compelling event. You should actually be forcing the compelling event if you're doing it right midterm, because they're going to go over and they want to buy forward whatever they can get to get better unit economics on it.
Yeah, exactly. So if the customer is forecast to overconsume, you definitely want to bring that conversation in early. Maybe you could even have some like overage forgiveness in those cases, but you want to like bring the customer onto a better plan for them. Totally agree. So another thing that breaks in my experience is the onboarding experience. And so this can break in a couple of different ways. Like, one is that the customer's paying based on usage. A lot of times they kind of like slow roll their adoption. Like, the adoption means they're going to be spending more. And so like, it's not like they've prepaid for everything necessary in a classic subscription manner. And it's like, they better get use out of this thing that they've paid for. If they're paying more based on consumption, you want them to move fast. They don't necessarily want to move fast. So how do you drive that adoption and ramp up to the steady state usage?
Whose fault is that? Is that the sales team having a disconnect with customer success to get them started? Are they not staffed the right way? Or is it just the customer's like, I bought this thing, but I don't truly know how expensive it is, and I'm kind of afraid of changing my architecture?
I think a lot of customers drag their feet with adoption. Like, they've signed the paperwork, they're ready to go, but then there's always reasons to slow roll change internally. It's like just always a lot of work required on their end to change their practices. They have an incentive to kind of act slowly anyway, but in this case, when there's not as much of a financial component kind of motivating them to act, they might slow roll even more.
So it's harder for a rep to actually blow out their number in many usage-based models. And so if you have a salesperson who's coming from a typical software background, they have to mentally reset what success looks like in a lot of cases. So your key metric in terms of effectiveness and productivity, it's no longer just defined based on them completing this booking event, right? It's, yes, I signed this contract with a customer, but that's really just a byproduct of their usage, which means they also have to think through how to expand within that customer account from a use case perspective, which means, oh, I have to go and actually hunt for workloads within each department where they can upload data. And so one of the sneaky challenges is what I'm trying to say is, in a usage-based world, it's harder for sales reps to blow past their number, which is kind of a culture change around paying people in a consumption-based model. It's harder to overachieve because the finance org is better at forecasting within an account where you'll end up, the data part of it. And also, you can't just sign a big deal and you retire it automatically.
Yeah, if you sign a $5 billion deal on December 31st, it doesn't have the same impact to your comp as in a classic subscription model.
Oh, and also in the classic subscription model, I would see reps absolutely murdered by pulling forward renewals. You can sign someone up to a larger contract, but you can't pull forward a renewal and use the entire booking to then retire.
Well, so another thing that can break in a usage model, I'm sure you're passionate about, CJ, it's just forecasting the business and having clarity of what's going to happen over the next year.
This is where it can get really squirrely, because usage based on the particular day of the week or what month you're in can be completely different. There's a ton of seasonality quirks in consumption-based models that are dependent on customers actually using the platform and then what's going on within their specific business during a calendar year.
Two things. Maybe we start with this first one. So it's, how do we get investors comfortable with a usage model, particularly given this predictability challenge? And then the second thing will be, how do we get customers comfortable buying on a usage-based model? So on the predictability piece, I think that, this especially becomes mission critical if you're going public or thinking about going public. If you have a 10, 15, 20% miss in your forecast, like, that just doesn't work if you're under that type of public company scrutiny. You wrote a great piece around Snowflake's approach to this, and I found that they've been extremely thoughtful in kind of reimagining what the forecast process looks like. So, walk us through what are they doing?
They were going to go public and they're like, we need to find a way to explain this to the rest of the world, similar to how Twilio did. But there weren't very great like one-off comps that they could just copy. So Twilio, yes, usage-based, but a lot of their models ended up being these larger ELAs that ended up looking more like a large subscription deal. The other potential comp was an AWS or an Azure or a GCP, right? The hyperscalers, the cloud gods. They were so big at that point that adding a net new customer wouldn't really move the forecast. It was like, okay, that's just around the margins because they still have to ramp. You have to remember a lot of these customers, it takes a while for them to ramp, as you hit on before. And so what they had to figure out was how to forecast customers who didn't have any sort of history before and try to find proxies for that within the business. And what they did was they looked at how many employees were there and then tried to pattern match that based on other customers that they already have on board.
What I see happening is the forecasting in a more traditional SaaS company would be like, all right, here's our revenue, here's how much is existing, and then here's how much is our new target. And with the existing, like, here's the churn that we're expecting, here are the upgrades we're expecting, or the downgrades. Like, it's very much based on historical rates of some of these different factors. And I think with usage-based businesses, as you're kind of alluding to, it gets much more specific. Like, you're forecasting at a customer level based on what you know about that customer, where they are in their ramp cycle, what are the characteristics of that customer, and pattern matching them to other customers like them, factoring in seasonality of consumption. And so I think the positive thing is finance gets much closer to the business and the revenue organization. And I mean, it's a very just like fundamentally different model.
I remember being in a traditional SaaS company and we just show up and ask the CRO, like, $100,000 deal, is it going to close or not? Yes or no? Like, is it in your commit? It's much more important to model the consumption trends of existing accounts. So things like how many credits were used yesterday? What's the day of the week pattern, right? Monday is usually the highest usage day of the week when people are in the office and working after the weekend. Which workloads are growing within each department? And then, like, did engineering at that customer just load another terabyte of data? What does that mean for it? So to your point, finance is very, very in the weeds on a per account basis, not just a binary, will this account close or not, and we can build them.
If you have VCs or you're looking for a venture investment, this type of forecasting discipline, it's pretty important too, because you might actually be underselling the health of the business and where you're going to be revenue wise. I found a lot of companies at the early stages, they don't get enough credit for the health of their business model by potential investors. And so the better you're able to be about forecasting what your business will look like, just the better story you'll have. But what are some other ways to get investors comfortable with these kinds of business models?
I think it's being able to explain the rhythm of your business in a way that makes sense for them. And so at Parts Tech, what we found was not every day of the week was created equal. And this is a smaller private company. This is not Snowflake scale, but Monday was when most of the orders would be. Then every day would go down by about 8 to 10% in terms of usage. And that's because after the weekend, mechanics were putting in all their orders for the jobs that they knew they had to complete, like this Honda Civic that they're doing on Wednesday and the brake pads. They want them to be there on time. And so I think to get investors comfortable, you have to explain why the numbers show up as they do, and that even though they're quirky, it makes them actually even more predictable. And based on that, you feel confident allocating the cost resources to support that revenue.
Yeah, that's an interesting one. I think a few other things that come to mind for me. One is you really can tell a TAM expansion story with usage-based models in a way that's very different from traditional SaaS. Like for more traditional SaaS, there is a cap on the typical deal size within different kinds of companies. But if you look at like Anthropic, I bet there are very small startups that might have like 3 employees spending $1 million a year or more on their Anthropic bill. Like the upside potential for your best customers just goes through the roof. And then there's also an element that I've seen at least where you have to talk about your business almost like a portfolio of bets. So with more of like traditional SaaS subscription, let's say you've got 10, 100K deals, you think 9 of those 10 will renew. Of the 9 that renew, maybe they'll spend a little bit more. Like it's very predictable and defined. With a usage-based business, you might sign up 100 customers. A bunch of them might end up not being successful and their usage is flat or close to zero. Like they're not spending a whole lot up front and they just never really get off the ground. And then you've got others that might start paying you $10 and now they're paying you $1 million in a year. And so if you think about the business as sort of a portfolio of bets, kind of like a venture business, you're underwriting to a lot of zeros and your returns being having this power law distribution. I think that's something that, like, if you have enough customers, your cohorts can look pretty consistent over time, but you just need to like teach the investors that this is how your business works and it's going to be outlier driven. And here's how you can get a sense for who the outliers are going to be relatively quickly.
And then to take it a step further to say, this is how big we think they could be if it all goes right. Because you're going to want to have this cohort-based conversation of this is how they start, this is how they mature, but this is what I think they can grow into, because that'll make the TAM, I think, tangible to them.
Now I want to talk about getting customers comfortable with the usage model. I think the biggest blocker is probably like the CFO and the procurement office.
Yeah, I don't think you can. So we can just end this section now.
Was there anything that like your vendors have done that made you be like, all right, I'll buy this?
Explaining what the hell a credit means. I think credit is kind of lazy. It's a way to label and encapsulate value that's often more helpful for the vendor than it is for the customer. If you think about it from my perspective as a buyer, I have 10 other different vendors who have a different definition of credit. So link back what the definition is to the activity we're taking in our company so I can understand it. And then make it easy for me to look at in real time, or as close to real time as possible, what we've done to date. So you have to have some sort of metering. It can't be over the top where like I need a PhD to understand this, but the ability to log in and see where we are, because I feel a lot better if I can check mid-month or maybe once a week. But if I have to wait to the end of the quarter to be like, boom, dude, you went over 250%, that's not going to go well for either of us.
They're either telling you went over 250% or they're not saying anything because you probably went way under and they don't even want to share that.
Like, just tell me something.
The best usage-based companies are also really good at like business casing with prospects. And so if you're a Twilio, for example, and you're selling SMS messages, right? Your customer probably has no idea how many SMS messages they're going to send as a business, and which makes spend really unpredictable. It just like really feels hard to buy. But if you're able to go, all right, you're using Twilio for appointment reminders. Well, how many appointments do you have? What's your no-show rate? How much does a no-show cost you? All right, here's how low we can get no-shows. Often if we send an appointment reminder like a day before and also maybe an hour before, do you want to send 2 reminders or 1, right? So you start basically helping them quantify what their usage could look like, and then therefore what their ROI could look like. It kind of changes people's perception of usage from this like black box to something that is knowable, controllable, and very aligned with like the success and health of their own business.
Yeah, you're speaking my language. You're translating it to whatever my value metric is.
From an ad spend perspective, for example, like I'm comfortable with usage-based pricing there because I know I'm paying for performance and I'm able to set caps on my spend. I know what my cost per lead is. Like, it's very different if you feel like that usage is aligned with the ROI that your business is getting out of the product.
Couldn't agree more.
All right. Any other things that you would recommend for vendors trying to, jam usage-based pricing down their customers' throat?
Yeah, make the renewal terms and auto renewal terms very clear to me. Tell me like truly if these roll over or not. So the worst thing that can happen is I underuse it, but I'm still bullish on increasing my use cases over time. And you tell me that I have to renew at like 120% of whatever I committed to last year and didn't fully use in order to use my stuff. In a lot of contexts, I think CFOs have this perception that usage-based pricing just shifts the risk from the vendor to the customer. Even if it is on me, I just want to know where that risk resides.
I mean, one thing I do appreciate with Snowflake's original pricing is that like when a lot of companies would say, hey, you committed to this much usage, you didn't use it, like it's a use it or lose it model. They did say, hey, if you underuse, as long as you renew at least the same rate as before, we'll roll over. That could feel like you just have this like bigger number that you have to hit next year. Like, I think that is more customer friendly. And it's like, it recognizes a lot of customers were slow to launch or they haven't fully deployed the solution. It just like gives them more encouragement to go wall to wall.
And something nice that they also allow you to do is to put those credits towards someone who will help better onboard you within the company. You put it towards professional services so you can increase your use cases more effectively.
Takeaways for people listening to this is really that if you have any sort of usage-based component to your revenue, like the lifeblood of your business is growing usage within the account. And so this isn't just like sales closes a deal, pushes it off to a account manager or a customer success person. Like everyone down to the finance team is thinking about usage on a per customer level. And it is like just so ingrained in the DNA of successful usage-based companies.
And think deeply about who you're hiring, because if you bring in sales reps from the traditional SaaS world, they're going to be very surprised that they're not instantly paid, or at least you shouldn't be instantly paying them just on the booking. They have to be more in the weeds and to fully understand what the customer needs out of it. And then same thing on the finance side. Finance can't be absent from this either. You have to be able to go down to the account level and understand the value your business is providing and how it grows within an individual customer.
Next up, we have got some business blunders, like when your voice cracks when you try and introduce this segment, but you'll never see that. Take it away.
Well, one of my favorite business blunders is this ongoing feud between Ramp and OpenAI. Did you see that, CJ?
Eric, we're back.
So Ramp's been putting out a lot of data lately that shows Anthropic is growing like a weed among their customers, and OpenAI is kind of flatlining. That's kind of the headline. They've got really granular data. And OpenAI, like, as you might have expected, is contesting the data. And they made a comment in the Financial Times that said the notion that the enterprise market share can be derived from Ramp credit card data is insane. It's a bit like saying global lemon sales can be calculated based on my kid's lemonade stand. It's pretty harsh, but Eric, the founder of Ramp, wrote back in a pretty great tweet. If your kid's lemonade stand processes 0.5 to 1% of US GDP, then yes, that's a fair analogy.
I thought that was a baller comeback, and Ramp's marketing team did a great job of embracing it and running with it. Like one of the top comments on here is jobs not finished, lemons not squeezed.
To Ramp's credit, like they have put out some data around some of the fastest growing products and the market share of different products across their customer base. And I found it's like actually pretty scary, predictable, probably not of the entire market, but at least like for a tech focused audience, it gives you a pretty good picture.
And at first I was like, wait, why would a big company be paying on credit card for an enterprise agreement? That'd be great for the points if you're allowed to, but usually not, because the company doesn't want to lose 3% through processing. And somebody said that. He said, our enterprise deal is usually done via credit card, would assume that's not the case. And Eric says, good question. Enterprise deals are often paid by bill pay, not card. Ramp processes over 100 billion there too, and many customers move hundreds of millions to billions monthly through the platform. So it does include stuff that you pay through ACH as well. So I would say the data is much more telling than not telling.
Do you have a business blunder this week?
On your newsletter, do you say Growth Unhinged is read by the chief product officers and chief marketing officers of company XYZ? Have you done the logo wall?
I have not done the logo wall. I probably should. Like it would make my newsletter look more appealing, but I have not done it yet.
There's a company out there that has logos Claude, Ramp, Cursor, and Adio, but it says loved by users of.
I mean, I could definitely do that too. I'm sure my readers are using other products. That is really bizarre.
Imagine if we said mostly growth, loved by drinkers of water.
Readers who visited countries.
People who went to Disney World this weekend.
Mostly Growth is a Mostly Media production. Executive produced by Ben Hillman. That's me. Additional production by Steve Sarasoli. Nothing said on this podcast is intended to be business or investment advice. It's the sole opinion of CJ, Kyle, and Ben. Just some guys who love talking growth. Mostly. If you like this podcast, hit subscribe and give us 5 stars. It'll only take like 2 seconds and our algorithm overlords love it. Drink water, call your mom, and have a great day.